Everyone, hope you're doing well. Welcome to the deep dive. My name is Drew Creekmer. I'm the Director of Advisory Services here at Creekmer Wealth. And today I'm joined by John Creekmer, our founder and senior wealth advisor. And John, we're going to cover some recent economic data and how we believe it's impacting markets and the economy at large in this conversation. But before we get too down into those weeds, how you doing today?
I'll tell you what, been burning like crazy, and it's been great to be able to meet so many people, different parts of the country, clients that we have. And I'm situated in Central Illinois and Morton, Illinois. Drew, I think we have clients in all 50 states, and to be able to travel and meet people has been a tremendous blessing. And with that travel, though, I've been able to actually talk with a lot of different either political leaders at the local level or small business owners or medium-sized business owners about what they're seeing in their industry. Everything from trucking to technology to healthcare to banking and financial services. And a lot of the information we're going to talk through today is actually brought to really kind of light from my most recent travels, and it just confirms with what we're hearing from those different industry groupings.
Yeah, absolutely. And so let's hop into it, John. The first thing we're going to talk about since August, this has been a pretty solid year for the market, but we've talked about quite a bit that the mega eight companies, so Apple, Amazon, Microsoft, they're responsible for the vast majority of the
Mm.
returns in the broader indices this year, the S&P and the Nasdaq. When you dig underneath the hood, it actually looks much different. The majority of stocks underneath in the S&P 500 are actually flat to potentially negative on the year, and so that speaks to a weakening in the broader economy. And so, John, one of the things that always comes up with a weakening economy is what is happening with employment. And so last week we got some employment numbers where actually unemployment did creep up for the first time in quite a while. And we're going to put a chart up on the screen that shows unemployment rates along with past recessions or financial crises. And what you'll notice is when unemployment begins ticking up, that's usually a leading indicator that something is on the horizon in terms of a negative economic event. And so, John, when we look at this unemployment data and this chart at large, what are some thoughts that you want us all to keep in mind?
One of the things to keep in mind is that employment is really the driver of our economy. So the reality is we are a consumer-driven economy. So whenever people become unemployed or they spend through their savings, whatever the case may be, their employment status, it greatly affects really the profitability of companies. And so at the end of the day, we want to make sure that we're paying attention not just to the frontline number. So oftentimes everyone listens to what's happening as far as just from month to month. But really, whenever we look at certain trends over comparing a short term to a long term trend, it starts to reveal things. Now, we know that whenever the federal government and the Treasury, based upon the direction of Congress in 2020 and 21, early in 22, infused a lot of money into the economy. They said they printed more money, and then they lowered interest rates down. And then correspondingly, the last 15 months raised interest rates 11 times for up to from 0 to 5.5%. We know that that caused a lot of turmoil and instability in all of the financial markets. But one of the things that we see, though, is that's also caused some instability in the overall employment markets as the economy has basically started to get back to normal running gauges. So, Drew, one of the things we look at is really a period of time of unemployment rate compared to its 24-month average. And we see that right here. We're taking it all the way back for over 50 years. And we've looked at every single time in history when the unemployment rate has actually started to surpass its 24-month moving average. And so every time that has happened, it's led into a recession that has ended up becoming a negative for the overall broad-based economy. And Drew, it looks like we just recently crossed that here just in this last month, haven't we?
Yep, that we did. That we did. And so that's definitely a leading indicator to us that, hey, we need to be mindful and aware of how much risk we're taking in our investment accounts, but also what are things that we can do to save money as we're going along our daily lives, because who knows when or what things are going to look like whenever we do have that event. And John, I think you talked about a lot saving money. Where I want to put a chart up on the screen that shows how extra savings have run out for most of the U.S. households here, going back to March of 2020. And what you'll notice on this chart is there's a massive increase for all population from March of 2020 through January of 2022 in their extra savings, so how much cash they had in their bank accounts. But basically coinciding almost exactly with when the Federal Reserve began raising interest rates, we've seen those savings begin to decline. And another chart, John, I really wanted to look at too is how are banks lending money? What are they doing? Usually when banks get stricter, with their lending standards, that's generally a sign that something is happening in the economy, a slowdown is occurring. And so this chart clearly shows in 2020, 2008, and back in the 1990s, whenever there's a spike up in lending standards and it becomes much more difficult for businesses to get access to loans, that usually says the economy is weakening, something is coming down the line. So, John, when we look at just the average consumers, me and you, what's happening in personal savings, but also looking at how banks are lending right now, how does that play into everything else that we're seeing?
It's interesting when you take those three charts and you overlay them, you see some very interesting correlation in all those. And if we look at the most recent one you mentioned, Drew, as far as the percentage of banks that are tightening their lending standards and how it's spiking up, and that really starts to correlate with the as we're charting this trend closer to the most recent unemployment versus the 24-month average. And so there's some direct correlation there. And so what that means is that if banks are lending less money or they're tightening their standards to approve a loan, then they're saying that we're going to be continuing to see the individual consumer is going to have a harder time paying back those loans because of a higher interest rates, because of extra fees, and because of unemployment creeping up. And so the bank is saying we want to take less risk. What also holds true as far as on their commercial debt. And so whenever they start to say, the unemployment numbers are going up, that means companies are having more difficulty with profitability. They're having more difficulty because their operating lines are also at a higher interest rate. Therefore, we need to tighten our lending standards. That makes it difficult for companies to expand and grow. If they have difficulty growing, that means they have difficulty raising their earnings forecast in the future and realizing higher profits in the near term, which means that there's going to be a little bit more instability in the U.S. stock market. We know that U.S. stock market ultimately moves based upon the underlying stock's ability, those companies, their ability to make more money in the future. And so at the end of the day, what the charts are telling us is that we're going to be seeing our country heading into somewhat of a recession. Not quite sure how deep that may be. It may be shallow. It may be a soft landing, as they're talking about, but some level of recession. And we know we're also continuing to see unemployment start to dribble up a little bit. And so that means instability. So that means you want to make sure that you have a very good understanding of the risk you have inside your portfolios right now. And Drew, I know that we addressed that even recently over the last 2 and 3 months. We have been actually taking profits off the table. And we've been actually increasing our safety positions across the board in a number of different manners, all for our clients. But on the individual side, clients want to make sure that they have a good understanding of the risk that they have and also what to do about that risk.
And so, John, talking about risk right now, it's been a nice bounce back after a rough 2022 so far in 2023. But we did begin decreasing how much we had directly in the market starting early in August. And we just did again this past week because a couple of our indicators we built flashed some warning signs to us that there's some downside ahead in the markets. And so we've already made adjustments for our clients. But, John, what would you say just broadly? I know you mentioned retirement, workplace, 401ks, 403bs. What are just some things that people should be doing on their own in their investment accounts, but also in their overall financial life to make sure that they're in a good position to weather whatever comes down the line of us?
Yeah, so whenever we have instability, one of those things that is preeminent in your mind, at least it should be, is that cash is king. And so you want to make sure you're increasing your cash positions, increasing your high interest savings positions, increasing your short term treasury and CD positions. And so you want to increase your liquidity. And so you want to find ways to raise dollars and liquidity to make sure that if we have instability, you're not going to be faced with a negative market performance. The second thing you want to be doing inside your retirement accounts is that you want to make sure you're properly balancing out your risk versus your actual cash. And in doing so, we're actually encouraging folks that if we're within 3 to 5 years of retirement or needing to access your retirement dollars, you're going to want to increase your safety positions just to make sure you have a little higher level of safety heading into next year. But also, you want to make sure that you have an understanding of the actual investments inside your 401k to make sure you understand the mutual funds or exchange traded funds you have, what the actual risk inside those are. So I'd say you want to really kind of gauge your actions truly based upon how soon it is before you need to touch those dollars.
Absolutely. I think that's some great advice. And so, what we would encourage you to do, if you have some questions about what John just walked through and just the broader economic picture that we talked about today, we would strongly encourage you to reach out to your advisor if you currently work with our firm. If you do not, we have a current offer of a free 15-minute risk assessment that I would strongly encourage you to take advantage of. Our team is happy to do that for you and walk you through the pros and the cons of where you currently are situated. And so a lot of opportunity out there, but also some risks to be aware of. And so we would strongly encourage you to make sure you're positioned well for what is coming in the months ahead. So guys, thanks for the time. Hope you're all doing well and that you have a great Thanksgiving with family, and we'll talk to you all soon.